Hello students, my name is Shesi George, your professional accounting teacher. In this video, we are going to discuss the concept of bank reconciliation statements. Bank reconciliation statements. Our learning objectives are to explain the following terms, that is A, bank statements, B, bank reconciliation statements, then 2, the reasons for disagreement between cash book and bank statements. Okay, now let me as a kind of introduction, the cash book, we all know what a cash book is. Okay, I've taught you, please try to watch that video concerning cash book. So the cash book is normally kept by the customer, while a bank statement is usually with the bank. So at regular intervals, the bank usually send a statement of accounts to the customers, informing them about their financial balances, okay, with them. So bank statement is usually prepared. So what is bank statement? Bank statement is usually prepared periodically and sent by the bank to their various customers. Okay, so the customers, we have to examine and compare his or cash book with the bank statements. Okay, so when the bank statement is sent to the customer, the bank statement will be compared with the cash book. This is bank statements. It will be compared with the cash book. All right. Then any difference between these two books, give room for the preparation of what? Bank reconciliation statements. That is to bring the two books to agreement. So we need to bring the two books to agreement. When the customer's cash book say it has a balance of 550 naira, okay? But the bank statement that is sent by the bank to the customer say it has a balance of 600 naira. So there is a disagreement. So we need to prepare a bank reconciliation statement. So what is bank reconciliation statement? Write it down. It is nothing but a statement that is prepared by an account holder for the purpose of finding out the differences between the cash book and the bank statement, so as to reconcile both books of accounts. So what brings about, so this is the balance in the cash book, why this is the balance in the bank statement. So what brings about this balance? What brings about the balance of 50? So we need to prepare a bank statement. Okay, bank reconciliation statement to do that. Now, the reasons, what could be the reasons for this difference? Number one is known as unpresented check. Unpresented checks. Okay, so what is unpresented checks? Unpresented checks are checks, write it down, that are yet to be presented to the bank for collection as at reconciliation date. The unpresented checks will cause disagreement between cash book and bank statements. So there are checks that are yet to be presented. Okay, checks that are yet to be presented to the bank for collection. Let's say the customer has issued some check, but those customers have not presented the check to the bank as at reconciliation date, so they are called unpresented check. Then the next one is called the dishonor check. So dishonor check also caused disagreement between cash book and bank statement. So what are dishonor checks? These are checks deposited into the bank but were rejected by the bank due to irregularities, that is irregular signature, insufficient funds, alteration in the check, differences between words and figures. Okay, brings about dishonor check. It will be rejected. Okay, checks that are rejected by the bank, okay, for clearance or for payments, they are called dishonored check. Okay. Now, thirdly, we have the uncredited checks. What are uncredited checks? They are checks that have been deposited in the bank but yet to be credited on the customer's account. Yet to be credited on the customer's account. Okay, they are yet to be credited on the customer's account as at the date of reconciliation. As at the date of reconciliation. So that is uncredited checks. Please write it down. Then the next one is called bank charges. What are bank charges? They are charges paid by the customer to their bank for various services rendered on behalf on behalf of the customers. So these charges are usually deducted without the customer knowing, until the bank statement is sent to the bank. Okay, until the bank statement is sent to the bank. So when these charges are deducted, the customers will not know until the bank statement is sent to the customers. Take note of that. Then standing order. What are standing order? These are instructions given by the account holder to the bank. Write it down. These are instructions given by the account holder to the bank to make irregular payments on their behalf. This order will be deducted by the bank without reflecting on the cash book, e.g. yearly subscription, insurance premium, and so on. So they are standing order. All right, standing order. Then we have credit transfer. That's another reasons for disagreement. Don't forget, these are checks. Write it down. These are checks or cash received directly by the bank on behalf of the customers without informing them until the bank statement is sent to them. The bank will be credited while the cash book is yet to be debited. The bank will be credited while the cash book is yet to be credited. So it will bring about disagreement of the cash book and the bank statements. Okay. Now the next one is called the dividend. What is dividend? Dividend is nothing but the profit received to a shareholder of an organization. That is what we call dividend. So it is usually paid into the bank, and the cash book is yet to be debited. When it is paid, the cash book is yet to be debited. All right. The next one is undercasting of receipt side of the cash book. Undercasting of the receipt side of the cash book. Okay. So when the income side, that is the debit side, that is the income side of the cash book, is understated. It means when the income side, that is of the cash book, is understated, it will cause disagreement between the cash book and the bank statements. Okay. Then overcasting the receipt side. So when the receipt side of the cash book is overcast, this will cause disagreements between the cash book and the bank statements. Okay. Then undercasting the payment side. The payment side is the credit side of the cash book. That's the payment side. Okay. So when it is understated, okay, the undercasting of the payment side of the cash book can occur, which will surely affect the total of the cash book and will cause disagreement between the bank statements. Okay, when the payment side, okay, is short. Then overcasting the payment side of the cash book. So the overcasting of the payment side of the cash book will also cause disagreements. Okay. Then we also have the bank error. What are bank error? Error normally are mistakes made by the bank, especially when posting figures and items to different accounts. So wrong figure, wrong calculation, and undue addition or subtraction brings about bank error. That is the mistakes committed by the bank, okay, brings about bank error. Now, in bank reconciliation, 2 books will be required. We have the adjusted cash book. Sometimes this adjusted cash book is called revised cash book, okay, or updated. Sometimes the question may say updated cash book, updated. So don't forget cash book. So it could be revised, it could be adjusted, it could be updated. So I want you to take your time, pause the video, and study the format. When you have a debit balance, it will be on this side. Credit balance will be on the credit side of the cash, of the adjusted cash book. Okay, of the adjusted cash book. Don't forget, you cannot have 2 balances. It's not possible. So it's either this or this. Okay, so when you have credit balance, and this is unfavorable balance, okay, why this is known as favorable balance. All right, then bank charges, of course, will be credited. That is payments out of the bank balance. Okay, dishonor check will be on the credit side. Overcast receipts, when this receipt side is overcast, you credit to reduce the overcasting. Okay, then undercast payments, when the payment side is reduced, so you add it back by posting a further credit. Okay, direct payments from the bank, maybe the bank has paid a particular creditor directly without informing you. All right, that is direct payment. Then standing order, I've explained that. Then we have balance carry forward. Then we have credit transfer, dividend, undercast receipts will be added back by a further debit. Then overcast payments. Okay, then you bring out your balance, normal accounting. Then we have bank reconciliation statement as at. Then the year, you write the year. You have balance. So the balance could be favorable or unfavorable. So it depends. So if it is favorable, it will be positive. If it is unfavorable, it will be what? It will be in brackets. So take note of that. Are you with me? So when we say balance as per bank statement, so if the bank statement shows a debit balance, that is unfavorable. So this will be negative. Take note of that. I will repeat. If the bank statement balance is a debit balance, it is unfavorable. You put this in brackets. Okay, I'll repeat once more. If the bank statement balance is debit, this will be in bracket. But if the bank statement balance is credit, okay, this will be positive. Take note of that. If the bank statement balance is credit, is positive. So credit means positive, debit means negative. Okay, then this will be positive. All right, then you have bank error, debit entry in error made by the bank will be added back. Then uncredited check will be added back. All right, then we have bank error, credit entry will be subtracted. Unpresented check will also be subtracted. Then you add these two together. Just add these two together to give you this. Add these two together to give you this. Then you add this, get a figure. Then you have balance per adjusted cash book. Okay, so if at the end of the day, this you start with unfavorable balance, this also may give you a negative balance. So that is unfavorable. So for cash book, take note. For cash book, when you have positive, so when you have debit means a positive balance. But when you have negative, that's credit balance. Supposing you have your balance falls on this side, that is balance brought forward is on this side. Okay, of course this balance would have been on this side. Okay, that is unfavorable balance. Students will take note of that. That is unfavorable balance. So this one will be negative. Okay, that is unfavorable balance. This one will always give you favorable balance. Unfavorable, so that is negative. All right, you can also start with, students will take note of that. You can also start with balance as per cash book. All you need to do is to reverse this. Okay, in the other way, let me show you. So as you can see, we have bank reconciliation statements. Okay, you can also start with balance per adjusted cash book. All right, add bank error credit entry on presented check. You add these two together. Then we have less bank error debit entry. Add these two together. You less it. Okay. Then we have balance per bank statements. All right. Then, as I told you, if you have this one is positive, that's a debit balance. But when it is credit, it will be in brackets. So just put this in brackets. All right. Then if this is also, if your answer is negative, you put it in brackets. So this means this one is credit, why this one will be this one will be debits, why this one will be credits. Okay, so take note of. So in the bank statement, the debit balance is negative, debit balance is negative, credit balance is positive. So it depends. So in the next class, we are going to bring a question and practice. Please, if you don't understand, please try to watch this video again. If you like this video, please share with your friends, and remember to subscribe to my YouTube channel. Please subscribe, share this video, share, and invite your friends to my YouTube channel. I remain your professional lecturer, JC George. Thank you. Bye for now.